Very good morning, everyone. Thank you for joining us for this webinar. This presentation is a debrief of our annual joint report with NASSCOM on the Indian startup ecosystem. The annual report is typically released in January, February of the year. It's a commentary on the previous year. We are expecting the report to be launched in the coming week. There is a joint launch being planned with the Government of India for this edition too. Now, as we go further, the first thing first is that what the startup as a definition really mean. You would be seeing a lot of different reports in the media, and invariably the numbers don't always tally. To make sure there's a consistency in terms of reporting, in terms of analysis on a year-on-year basis, NASSCOM and Zinnov have a very specific definition in terms of what constitutes a startup. Important, this does not necessarily match the definition by DPIIT for a variety of reasons. In this report, the startup definition is of an entity which is working towards innovation, development, deployment, commercialization of new products, processes, or services driven by technology or intellectual property. We are looking at companies which are less than 10 years old, whose origin is India, which means the founders are Indian, predominant product development, or the more than 60 to 70% of the team is sitting in India. But it could be headquartered anywhere in the world. So you would see US headquartered companies, you would also see Singapore headquartered companies here. There's a clear differentiation of innovation, and innovation here entails business model, business process, and of course, technology. Most importantly, these companies are not paper companies. There is at least a prototype which has been deployed with customers. There is active customer adoption or interaction with the product, and consequently, they can be said to be working towards a larger scale. Now, given that particular part, here is a real quick snapshot in terms of where does the startup ecosystem lie today. Overall, what we're looking at is about 25,000 to 27,000 startups being active in India today. About 5,500 of these startups, roughly about say 1/5, have raised some kind of equity funding, starting from seed to late stage funding. This pool, which is the pool incepted between 2012 to 2022, has raised close to about $73 billion so far in terms of investments. Right now, a quick call out here. If you look at the numbers, almost 1/4 of this number was raised in the last year. Now, it's been a difficult year. All of us know it. We've read a lot of stories, but what does that really mean is what we're going to get into in the subsequent slides. In terms of the overall ecosystem, I think what's been amazing is that very much similar to your investments, almost 20% of the exits in the ecosystem came in the last year. There have been about 1,000 plus exits, roughly 200 came in last year. Similarly, if you look at the number of potential unicorns, almost 1/3 came in the preceding year. So it's been a very interesting year in terms of talking about drop in funding, talking about slowdown, quarter on quarter. But when you look at it holistically, the numbers, certainly seem not that bad. They seem rather interesting in terms of the story, which is really emerging. Now, funding, first things first, right? There is a drop in overall investments, which came into the startup ecosystem in the year 2022. It's roughly about 24% decrease compared to the previous year. 2021 has been the record year, not just in India, but globally. And similarly, in 2022, the previous year, we have seen investments drop across the world, not just in India. To make this analysis a lot more specific, what we have done is we have used a 4-year average across multiple areas. Now, the key reason for this is that 2020 was an exception year because of the pandemic. There was a lot of ambiguity in the market in terms of how business should be designed, how business should grow, and of course, investment slowed down. We saw that both in public markets and private markets. In 2021, for a better part, there has been a lot of exuberance in terms of the economy opening up. There was also a lot of overhang of thesis or behavior from 2020, which was driving growth for a lot of technology companies and businesses in general. And because investors were not able to deploy money in 2020, there was almost like a revenge investment coming in as fund managers were looking to solve for IRR. And we have seen this number consequently jump across the board in terms of investors looking to actively invest, public market shooting up in terms of valuation, and a lot of overhang in terms of behavior from COVID time, the core COVID period of 2020. However, in 2022, what really happened was that behavior started to change once again. Take, for example, education, take, for example, healthcare, take, for example, fitness, wellness, supply chain, transportation, hospitality, mobility. all of them have started to sort of see a shift towards pre-pandemic behavior. And consequently, a lot of growth rates of tech companies start to change. Similarly, there had been a strong investment happening here in terms of technology spends, and that started to get rationalized in 2022. You, of course, know of the Great Resignation, which sort of moved complete ROI for technology companies because salaries became so high. Bringing all of that together, 2022 in essence became a year of correction at multiple levels. And consequently, what we understood was that it's better to take a 4-year average of 2019 to 2022 and then look at all the numbers to figure out what really happened, how good or bad this year really was, and what could 2023 really entail. Key points, despite the investments going down, you would see that number of deals went up. We had about 1,400 plus startups which got funded through the year across about 1,600 deals. About 66% of investments went into non-unicorn companies. The reason that number is really important is because startup ecosystem is again, how we look at the consumer market. So there is the upper class and there's the low income group. You don't want a lot of capital to go only in the upper income group, right? You need a good distribution across the board. It talks a lot about the breadth and the depth of an ecosystem. And 66% going into the middle income group or the low income group, kind of a parallel, which is the seed stage in the early stage and parts of the late stage, is really good from the ecosystem. It typically alludes to a strong pipeline of startups being there in the ecosystem. In terms of funding now, what's really happened is that the biggest drop in investments was almost in the late stage funding, which is there, right? So from $24 billion, we went to about $18 billion. That's a $6 billion gap. And if you see in late stage funding, you're seeing about $7.6 million drop, right? So almost all the, funding crunch, which happened was in the late stage funding. Now, there were 2-3 reasons for this. Number one was in the public markets. You would have seen tech stocks constantly going down from January of 2020, from mid 2021 through 2022. They've been consistently moving down. Specifically in 2022, between Jan and December, December was the lowest period for valuation of any publicly listed technology company. The multiple, went from say roughly about 8 to 15x pre-pandemic to about 15 to 30x at the peak, and has come back to say about 5 to 10x currently, right? This shift of valuation basically put a lot of investments of 2021 into negative returns. And because there were negative returns, investors had to figure out what to really do in terms of expanding their particular share. Should they book the losses or should they not book the losses? Became a very, very big question for them to try and figure out in terms of execution. Now, as these public markets end up changing, the immediate effect was in terms of the private market. So if in 2021 you were really confused, or if in early 2022 you were really confused as to why this company became a unicorn, you were not alone. Everybody was confused. And a very big reason was the valuation, because of which, you could be doing only about 100 rupees in revenue, but raise 10 rupees more and get $1 billion valuation, right? It was pretty insane in that sense. Now, while this was happening, the immediate effect again was in terms of the mega rounds. These are rounds which are more than $100 million in terms of round size, and a 41% drop means that about, say, if there was $10 billion in 10 rounds, now $4 billion just disappeared because 4 investment rounds did not happen, right? So that's where the chunk of change is really happening in terms of investments. $6 billion short, overall, 7.5 billion short only in the late stage ecosystem. And what that meant was that while late stage was crashing, early and seed stage investments actually grew up in India, right? We saw uptake both in terms of number of deals. We saw uptake in terms of number of startups funded. We saw uptake in terms of total amount raised. There's a very good and very decent consistency which is coming up on both early and late stage. If you compare year on year, and if you compare with the 4-year average, you can very safely say the trend line is moving up, which is there, right? So even in the worst case scenario for late and early stage this year, we expect the numbers to either be similar to 2022 or at worst somewhere between 2001 and 2022 in terms of numbers, right? That's the worst case scenario. Best case scenario is it will be higher than 2022. Most probable scenarios, it will be similar to 2022, right? So this is a very important point in terms of where the crunch is really coming and where it is not really coming. Now, as we look at that particular part, the second question comes is that are only unicorns raising money? We saw that's not the case. 66% went to non-unicorns. The second question which typically comes is that are we seeing same startups raising money, or have we seen net new startups getting funded in the ecosystem? Are newer companies able to raise capital? I think 2022 in that sense has again set a very good baseline of 47% in terms of the companies, unique companies which got funded, raising their first round ever. This trend line again, sets up pretty well, being similar to 2020 and somewhat lower than 58% of 21. Tells us that most likely will fall somewhere around 45 to 50% for this particular year. It may not be as good as 21, but it should most likely be, again, similar or higher to 2022. The other factor, which is very, very critical, is in terms of investor appetite. Now, 21 was a great year from a valuation perspective. Remember, in 2002, investors have seen their investments crunching. They have seen negative returns in terms of their late stage. A lot of paper value which they had created through the year is now getting washed out because the multiples have fundamentally changed, and consequently the risk appetite certainly changes. You start to become a lot more conservative. Here we have seen sort of reversal to the normal, where instead of taking very active bets and sort of being able to invest with lesser evidence, in 2022 investors have been asking for a lot more evidence, whether this company will be profitable, whether it will be sustainable, is this valuation really justified? If you give them a certain multiple now, will they really be able to grow into that before they raise the next round, or will they be looking for a lower round of funding? A lot of questions, a lot of debate, but end of the day, what it boils down to is investors asking for a lot more evidence as to why should I really invest in the company today? Why should I not wait for 6 months more? The other aspect, which sort of came out in the market, which a lot of you are familiar with, is what happened to the tech stocks. I think it was a brutal year in terms of how these companies have fared on stock exchange, not just in India but globally. There were two key impacts. I think one, a lot of listed companies were biggest losers in most exchanges across the world, India also. This essentially ensured that number of IPOs end up slowing down significantly compared to what was expected. And then number three, of course, it just became a lot more difficult for them to start justifying the valuation, work a lot more harder before listing themselves on the market, purely because the retail and institutional investors are not doing a lot of scrutiny. Now, while IPO is not doing really well, and while tech stocks were not doing really well, if you look at M&A, there is again a very interesting part, is that there's not really a significant drop in terms of, the number of M&As which happened in 2022 versus 2021. The real change essentially happens in terms of composition of who's doing the deals. So 21 startups were flush with funds. They were very active acquirers. But 22, as access to capital became difficult, you see the composition shifting. You see corporates becoming a lot more active in terms of participation, specifically Indian MNCs, right? And that is, what our assessment for 2023 also is that if you're a corporate and if you're looking for strategic acquisitions and strategic investments, now is the time for you to really act. Next 12 months will create a lot of opportunities for acquiring and for acquisition. As founders still fight, for investments from, for their follow-on investments. But that being said, valuations are significantly reasonable compared to what it was in the last 2 years. So, funding or no funding, I think from a valuation perspective, it's a fair market value. It's easier to negotiate a price. The returns are a lot more attractive. The business cases are a lot more easier to build and justify on that particular part, right? So IPO slowed down. Tech stocks did not do really well in public markets, but M&A was almost untouched. This particular year, we're expecting something similar. We do expect M&As to be of significant importance. Yes, there is a talk of recession, but we believe that Indian MNCs will again have a good year for this year and next one. With recession, usually Indian companies end up growing. Indian markets usually do well. So they should be flush with funds and they should be pretty active in the market. What we're hoping for is that the global MNCs also will be equally active as far as Indian ecosystem is concerned. We do definitely anticipate them to be active in the local markets, just from a smart buying perspective. What has also not changed is the core reason for these acquisitions. Product portfolio expansion, building tech capabilities, market expansion continues to be the top three reasons for companies to go out and acquire a startup. Portfolio expansion is typically seen in terms of entering a new customer segment or entering a new territory in an adjacent or a new business space for the company, right? It's not always in the core. A lot of activity happening in the adjacent space from an M&A part, not so much so in the core as such. And we'll again talk more about this. Now, a very common question which comes to us when you talk about investments is to say that, hey, which sector is doing well, which sector, sort of was the biggest loser? Should we be really excited about things? So what we did is we created a heat map. We said, okay, let's look at investments in 2009. Let's look at the 4-year average and then compare that with 2022 investments, right? And if you see the dark green here, majority of the sectors are dark green. In terms of raising more money than the 4-year average and also than 2019. There are only few sectors where 2019 was a record year. The 4-year average is lower than that, and investment in 2022 was again much lower than the 4-year average also. And if you see, these are essentially sectors like mobility, supply chain logistics, fitness and wellness, automotive, and odds are you would know why. These are all sectors which require a strong manufacturing element. The base was significantly high in 2019. The business model was similar, but the consumer behavior had completely changed over these 3 years. It's only now that travel and hospitality has come back to pre-pandemic levels in terms of volumes, starting to sort of increase beyond that also on an annualized basis. Automotive is just starting to pick up in the last 6 months in terms of the number of vehicles being sold increasing steadily. Supply chain logistics is again expanding a lot more differently, this time in terms of creation of new assets, not just in terms of optimization. And of course, mobility improving as people come back to work, as they start traveling a lot more, as they start shopping outside a lot more, right? So these are the sectors which were heavily funded in 2019 because of pandemic. There was change of consumer behavior. Consequently, the investments reduced in 2020, 21, and also in 2022. A few callouts, what you would see is that education, for example, is lower than the 4-year average. We have seen a lot of articles on Byju's, for example. And the reason is very similar. I think what simply happened is a lot of consumer behavior, which was induced by pandemic, is reversing. People are finding new ways of doing things, right? So suddenly your market sizing completely changes because initially everybody went to work, everybody went to school. Then nobody went to work, nobody went to school. Now somebody's going to school, every day. Somebody's going to school a couple of days in the week. Somebody's not going to work. Somebody's going to work every day. Somebody's going to work for 2 or 3 days in a week. The whole model completely changes. And it has a different, and very direct impact on your business, on the metrics that you end up achieving, and consequently the story you can tell to investors, right? So this element of shift in consumer behavior or the customer behavior through 2022 has also been an equally defining factor in terms of what's happened across the world. Now, if you look from, from what do you say, from a data perspective, what we try to do in the report is that we have tried to focus on sectors where we say that, okay, what was their ranking? Relative ranking in 2019 versus each other, and what was the ranking in 2022 basis the total investments raised. So you take all the sectors, you put all the investments, and you do a ranking on a year-on-year basis, right, which is there. The sectors in green have moved up in ranking. The ones which are in somewhat purple color have moved down, while the blue ones have been neutral. You would see BFSI and retail have continued to be more or less in the top 3. But there is a consistent growth in enterprise, in social platforms, advertising. Agriculture has done nicely in human resource, media, entertainment, life sciences. These sectors have done really well. At the same time, something like the hospitality has dropped. SCM has dropped relatively because of the sectors were putting more capital. And all these sectors, if you see, majority of them are the ones which are still lagging the 4-year average from investment perspective, right? This is a very quick visual view in just to give you a sense of what really happened in 2022 and how is that impacting different sectors and in terms of market adoption, in terms of investments, etc. A few sectors just to call out for everybody where there has been a fundamental shift and a very, very consistent uptick over the years. We have seen food, agriculture, energy utilities, industrial manufacturing, media entertainment, human resource, you would understand why. Social platforms consistently increase the funding and investments that they're getting. This is purely on back of market adoption, which is happening. If you see majority of these sectors that you have experienced, your interaction has really changed with them. And these are also sectors of national importance. So to say, so agriculture, recently in the budget, there's a new fund which has been announced for it. Energy utilities, industrial manufacturing are two very, very big pushes that the government has into the PLI scheme. Food is something with Zomato, Swiggy, you have already seen, but you've also seen the shift in terms of restaurants, responding very differently in terms of commissions, or Horeca industry completely changing. Media entertainment, advertising, the consumption trends have really changed, right? So these sectors were abysmal, in 2019, but through the COVID period, there has been a fairly consistent increase. There are a few sectors we are pretty excited about. Environment tech, because of sustainability, is picking up consistently. Our hypothesis is that this is still a sub, 100 million segment, but this can really become a big winner for Indian ecosystem going forward. Predominantly because the scale and the complexity of the problem in India is insanely high compared to any of the developed regions or other developing regions. And this is where it's a perfect mix for disruption, for new solutions to be created to begin with. Aviation, maritime, and defense, this is a segment again of national importance, significant spends from a GDP perspective, a lot of room in terms of, creating new businesses. Almost every large conglomerate in India has been investment in this area in the last 5 to 10 years. It's no different for startups. It's a new industry. If you build a product, ability to get an exit is extremely, extremely easy today. There's just a lot of capital waiting to buy you out from solutions perspective. And this is again, very domestic spend. I'm not even talking about the export market. Finally, is the life sciences. I think in life sciences, what happened through the last year was that a lot of capital was getting moved into stronger bets, into more confirmed bets. This is starting to change slowly and steadily. Not too much volume yet in this particular space, but we're seeing a lot of chatter happening in universities in terms of looking at, building solutions, which solve for healthcare, which also solve for life sciences, the drug discovery part at a very, very fundamental level, which solve for treatments at a very fundamental level, go beyond diagnostics, go beyond awareness. Early days, but again, a lot of action happening there. Now, usually one of the questions which always comes from GCOs is to say that, hey, look, how many deep tech startups are there? Does India have a good ecosystem? No major shift, in terms of 2022 versus earlier years. 12% of the ecosystem is building deep tech solutions. I think there are about 3,000 startups which are building these solutions. Roughly 500 to 600 of these startups can be categorized to be cutting edge in terms of inventive startups because they have multiple patents to their name. And there is a lot of emphasis that they have in terms of creating net new solutions for problems in the world. So you would see companies 2, 3, 4 patents, but a single product, right? The growth rate is consistent, roughly about 42% over the last decade in terms of CAGR. 78% of them are B2B, so that remains the key driver for this particular segment. From an investment perspective, this pool had a good year. We are seeing roughly about $3.6 billion coming in. From an investment perspective, it's a small base, small pool, and hence, you are seeing that uptick. But again, from a trend line perspective, we believe it's going in the right direction. There has been the right uptick in terms of seed stage, which saw roughly, an increase of about roughly $200 million. It went 3x to previous year. Whereas the early stage investments, went about roughly 2x. between 2022 and 2021, right? So still early days. I think our summary statement on deep tech would be is that where the Indian ecosystem was in 2015-16 is where the deep tech ecosystem is today. In the next 5 to 7 years, before the end of this decade, I think we'll see a really, really powerful, deep tech startup ecosystem in India, which is really taking on world a lot more prominently, a lot more commonly than it is today, right? So it should take another 3 to 7 years, but again, pretty optimistic in terms of what's happening there. From a unicorn part, and I'll not spend too much time here. Going back to that fundamental reason that because the valuations have changed, you now need lesser metric and lesser money in terms of reaching the unicorn status. And if you think from that lens, this 42 unicorns makes a lot of sense. And because now the valuation multiple has changed again, the drop to 23 again makes a sense, right? So it's almost like the underlying asset is still performing similarly, but because you're valuing it differently, it's moving to unicorn and a non-unicorn status purely based on how the public market looks at it. And we know markets are not always reasonable or always smart. But that aside, I think what we are seeing is a shift in composition. This year, 74% of unicorns were B2B startups. 30% of these companies had a SaaS business model. We had 23 unicorns across 10 different sectors. So good variety, but the biggest call out for you is that yes, the pace was slow, but the composition was very different. This was the year of B2B startups in terms of achieving the unicorn status, and then sort of changing the narrative that India is only a country of, Flipkart or Ola or American ripoff in that sense, right? In terms of the potential unicorn club, these are companies which have raised at least $50 million in cumulative funding and have a very high probability of becoming unicorn in future. You would see that the numbers are actually better compared to 2021. Again, two reasons. We saw early stage investments being very consistent and growing. We saw that within late stage, only the mega rounds were the ones which were heavily impacted, which means there's still funding going, but smaller quantum in terms of each round size at a different median round size. And consequently, both these factors sort of end up helping move the potential unicorn club up. Beautiful points. 50% of them are B2B, 50% are B2C. It's a perfect split right now. Roughly about 70 plus companies have raised more than $100 million. We again have a very good mix in terms of spread across 22 different sectors in the ecosystem, which has potential unicorn. And even better is that almost 40% of these companies are already servicing global markets, right? So our whole hypothesis that India can build products and sell into the world and achieve a certain fame and certain business level seems to be getting proven more and more in terms of the composition of the companies and the fact that they are hitting global markets a lot more earlier than was traditionally done. Now, while all of this activity happens, the two main questions come from your perspectives to say that, okay, look, what does this really mean for me? Were we even seeing, a more activity happening from investors or corporates? We saw the volume activity, we saw the value activity. The next is who's really doing this. In spite of this whole slowdown happening in the funding in 2022, we are seeing more investors, becoming active in the ecosystem today. The number of active VC firms is almost 2x of the previous years. The PE firms are also becoming more active. Again, a similar 2x increase. Number of corporates have increased. And again, the increase reflects a lot in terms of the area where the activity was. So a lot of growth in terms of sub-$1 million rounds. $100 million rounds by themselves reduce, of course. There is a dip there. But at the seed stage, early stage, Series B, Series C kind of part, you are seeing a good uptick in terms of activity. Why is this important? Because this tells us that while the money started flowing, people are still keeping a very active eye in terms of what the ecosystem can offer. This trend line is very similar to what's happening in US, what's happening in Europe. The difference, of course, is that the growth of investors there is significantly lower compared to India for a variety of reasons. But we are starting to approach very consistently a construct where American investor, European or Japanese investor is actively seeking opportunities in India, either through their own network, through their own offices, or being part of a consortium which is investing here. But there's definitely a lot of conversations and a lot of time and energy being spent in terms of figuring out the opportunities. On the corporate side, what we have is a construct where we again have seen increase in terms of participation. There's almost a 2x growth compared to 2020. The majority growth in terms of corporate participation came into areas which was investments and open innovation programs. Investments continue to be extremely interesting for companies in terms of participation. But again, it's a combination of efforts. You will see a company running an open innovation program, also acquiring and also investing in companies, and that pool is again, very, very consistently increasing. Overall, 30% growth in terms of across the board of corporate participation, roughly 40% odd growth, in terms of investments alone. Now, if you look at the investments as a double click on this part, you would see that there is a good uptick in terms of seed and early stage investments. This is rather interesting because this almost alludes to companies wanting to, take on bets a lot more early, looking at investments as a fairly feasible option of expanding their portfolio, keeping the risk low because it's only part ownership. At the same time, getting access to a lot of good quality talent and good quality products to figure out, if they should even invest there or, deciding to make the investment while internal project is also going on. Roughly 17% of all the funding deals which happened in India has at least one corporate investor. Once again, Indian MNCs were a lot more active compared to global peers. This is again something very classically understood in terms of what's happening from a recession perspective in the West, and consequently the shift in some of the tactics that the companies were deploying. So that's one very big reason which is going in. But there's also this whole aspect in terms of what is it that India can offer, and the Indian companies also becoming a lot more comfortable in terms of adapting investments as an approach to grow. From an M&A activity, very consistent trends. MNCs are active buyers. Indian corporates are becoming a lot more active. A lot of acquisition is still happening in terms of proven models. So you will see very low number from acqui-hiring perspective, very low numbers in terms of early stage acquisitions. These are typically firms which have somewhat revenue, set of customers for which you are buying the solution, not just for the technology or not just for the team. So again, very, very consistent. We believe Indian MNCs will continue to play a more critical role going forward in terms of understanding how this playbook should really be executed. And hopefully, of course, sometime mid of this year, end of this year, we should see global MNCs also becoming a lot more active from a cross-border part. Finally comes the open innovation part, and this is one thing we have always maintained, pandemic, no pandemic, it's fundamentally increasing. I think I'm personally privy to at least 10 corporates launching an innovation program this year to actively work with startups. A lot of mix and matches happening. I think one thing which COVID changed was that it sort of confirmed that to run a startup program or open innovation program, you don't need a physical setup necessarily. You don't need a very cool working space. What you need is great problem statements, a set of people who really want to commit to solving that POC, a group of people who know how to orchestrate the ecosystem. And then eventually majority of these are technology software companies. So location doesn't really matter. And in that mix, a lot of Indian GCs, Indian MNCs are working with Indian startups, but also with global startups, right? And that shift of suddenly opening up the world, converting a database into something very, very actionable, regardless of the location, has been one key drivers. And this year, with recession coming in, with the CTOs facing a lot of pressure from the CFO in terms of capital available, there being a need for optimization. At the same time, we need to continue experimentation. This is an area that specifically in the G Suite construct, you want to really keep an eye on in terms of what your plans are, what your competitors doing, what other companies are doing, right? Finally, 2 slides to understand where we are headed in 2023. The report ends up including a survey of founders to understand what their sentiment is and what their action plan is in terms of the ecosystem. Here's the interesting part. There's a lot of chatter in terms of layoffs in startups, but when you look at all the data, you realize that 70 to 80% of the layoffs only happen from roughly 10 companies. That's about it. The remaining 20% has come from a long tail of companies rationalizing their teams, predominantly to work on the cash flow, and secondly, in terms of solving for overhiring, which happened, alluding to the growth rate which is there. The main concern even now is actually hiring and the investor sentiments. There is a lesser worry in terms of market recession. As far as valuations are concerned, majority of them are very comfortable in terms of sort of living with the current valuations, not really expecting 2021 valuations to return. A lot of emphasis on business expansion, but overall extremely optimistic in terms of revenue growth, hiring, and fundraising, right? And consequently, what we are expecting for this particular year is that some of the key elements in terms of SaaS, B2B, deep tech, this pool is still smaller in that particular sense. It's of a significant size, but relatively smaller. We'll continue to see growth. These are themes which are going to be still active, still relevant, this year, next year, and coming years. So we'll see that ecosystem becoming very stronger. In terms of investors and corporates, in the initial 3 to 6 months, we expect the pace to be somewhat slower. But starting Q2, which is the post-April period, is where you'll certainly see an uptick in terms of deal activities, both from investors and corporates, as they look to sort of chase down the opportunity at hand. They have gained confidence. One big reason we believe this will happen is because if you look at public markets for technology stocks, it seems that in December and through January, the stocks have started to turn in terms of the valuations. They start to stabilize. And if in 3 to 6 months, public market starts to stabilize, then by default, this activity will pick up. Now, with this pickup, investments are expected to be at least, similar to a 5-year average, which means it might be somewhere, at 5-year average, but at the same time, slightly below 2022. It's very, very possible. Again, not for any other reason, a good part of the year, the first 3 to 6 months are still going in terms of understanding how the valuations will be, what multiple to give, waiting for the markets to stabilize. And as soon as that happens, then you're able to execute your deals, right? So it's a classic case where you want to buy a property. You believe it's a great property, but the market rates are fluctuating a lot. You just want to figure out where will it sit before you end up deciding, to actually do the transaction. This has effect on unicorns. We expect a similar pace eventually to 2022 in terms of 15 to 20 unicorns, 25 unicorns getting set up this year. But most critically, exits is where we are expecting a good momentum. I think we should all start hearing a lot more news, a lot more chatter about IPOs coming in, both from tech services and tech products. Most of those announcements are going to be queued for Q2, Q3, with ideally listing happening by end of this year. But it'll be a ramp up again. It'll ramp up from Q2 onwards into Q1, Q2 of next year. So the next 12 months is where you will see the whole IPO ramp up happening, right? That's all we have here. It's a large report. It's almost about an 80-slider report, which has been created with NASSCOM. The release is happening next week officially. This is an early prelude or a debrief for all of you on the call here. I'll maybe open up the floor for questions and let's see what do we have here.
Thanks, Atit, for this presentation. We have got a lot of questions, few on the expected lines even before we started. Couple of them that we have is, the first question is, how are startups being leveraged by GCOs specifically? Are they delivering success rate? Also, is the definition of success rate changed compared to 2020, 2021, and how it's going to be in 2022 per se?
Got it. I think fundamentally GCOs and all the technology teams in large enterprises, they are looking at startups actively for sure across the board. And these are being looked from 2 or 3 different perspectives, right? The one perspective, of course, in terms of reducing time to market, which is there, or in terms of reducing the cost of a solution, or in terms of making a more holistic solution. But I think one major change which has happened in the last 3 years is that the way companies are calculating return on investment. Now, technologists understand that not every bet will be successful. If you want to innovate, there's need for experimentation. There's a lot of data for it. but there's also need for a lot of smart experimentation. Now, given that you have a lot of cost or a lot of time required to hire the right people, can you leverage startups to run quick POCs to validate a particular hypothesis before investing further in it? So the first year, the second year, the third year ROI model now includes a cost of experimentation, which says that with a startup, I could test out an idea in 3 months with $100,000 versus doing this in 9 months with a team of 5 people for $500,000. I'm still moving forward at a lower cost. I'm still able to figure out what works, what doesn't work. So that's one big shift. And because of that is where a lot of activity has really picked up in terms of GCs and technologists in general wanting to work with startups. It's to improve the pace of experimentation, reduce the cost of experimentation as the leading indicator, and business impact and time to market being the lagging indicator.
Got it. Thanks, Atit. Another question specifically to healthcare. How are corporates leveraging startups specific to healthcare industry?
I think we're seeing 3-4 scenarios happening there. Healthcare is also undergoing a whole construct of platformization, very similar to what happened with mobile phones, what happened with, say, Android or, with iOS. So there are companies that are building these technology ecosystem platforms, and they're leveraging startups to sort of solve for the platform adoption and evolution, wherein you strengthen your product by working with a key partner to say that, okay, can this integration happen in 3 days or 3 months or 3 years? Accordingly, build your technology profile, and of course, bring solutions on the platform so that people can pick it up. This eventually leads into a joint go-to-market kind of a scenario, right, or post-sale scenario. Second is bundling in terms of, you are a IT service provider, for healthcare, and you suddenly realize there's a lot of digitalization happening there, specifically think from a COVID perspective, right, where you don't really want to do everything with pen and paper. How do you now suddenly, update the workflow? But as you're updating the workflow, can you integrate an AI diagnostic solution, which can be now given to the physician? And you're no longer only servicing the administrator in the hospital, but also the physician in the hospital, right? Similarly, you're launching a new product, you don't have the full stack. So can you do an integration with one of the companies leading in, say, for example, remote ICU kind of a development, and your networking devices are required for high fidelity transmission, but you're deeply integrated. So every time the startup sells a product, your product is also taking off the ground, right? So different ways, different mechanism. There's also a lot of fundamental research collaboration happening when the technology of the digital team in a large pharmaceutical company will create a portfolio of startups which are working on genomics or on different kinds of patient data or patient access or clinical trials or clinical payments, but offer all of these solutions to their businesses to reduce, say, the time to drug discovery or the cost of drug discovery, right? So the digital team, while building its own technology stacks, is bringing a lot of these startups as capability for the business to, say, solve for drug discovery, as an example.
Understood. A very unique question is identifying use case for startup collaboration can be hard. For example, many times leaders prefer to build technology in-house. There's also low trust on longevity of startups. How are companies tackling this? Also, to add on to that, let's say a company already had a startup collaboration program, but didn't got the success which they were looking for. Is it a right time to relook at that strategy, or what do you think on that?
Yeah, I mean, I think it's always good to baseline, what you're doing to figure out if you can do it better. So I think in that sense, competition or compete or peer analysis always helps in every activity in terms of just knowing where you stand. That being said, I would not always recommend peer or compete analysis to decide what you should do. That's something very contextual to your company. And in that particular sense, I think there is a lot of merit to look into what are the real problems where a startup program doesn't work. Usually it comes down to elements of design, where you don't have the right people involved at the right stage from making a decision. You're not able to figure out, the right use case. The approach is to say that let's look what's in the ecosystem and we'll figure out what to do with it. You find a very cool startup, you take it to the leadership and they say, hey, look, we already have a team here. Or we're already doing something with somebody in Israel or something, with somebody in Latin America. All right. So in that construct, use case identification validation becomes very, very critical. And that's, I think, a construct where in general, outside startups, from an innovation perspective, from experimentation perspective. Now, a lot of technology teams are creating strategy desks where there's a strategy person sitting in the CTO's office or the India Center's office, and what they triangulate is that, okay, is this particular use case critical for our business? Is this use case common in our industry in terms of what our competitors are doing? Is this use case where I have capability or not high capability? So any use case which is critical to your operations, but there is low industry adoption and you don't have a capability, becomes a great fit for startup investments. It's critical to you, it's high industry adoption, you don't have capability, it's great for acquisitions, right? It's not critical to you, it's industry adoption, you don't have the capabilities, great for commercial partnerships, right? Now, why is this important? Is because it allows the CTO to proactively manage their portfolio and make sure the right teams are getting investments internally. At the same time, they have the startup program as a capability to keep doing the job better, right? So it just makes the technology teams a lot more powerful. I think that's where a lot of effort is going today. I've seen that let's bring in the market data, the technology data, and the industry data to systematically identify the use cases.
Understood. Another question, and this is in relation to even our upcoming SaaS report, which is there. Can you comment on the B2B and the SaaS startup in India? How is their competitiveness with global startups? It's a very interesting question. We'll be hearing this a lot in the last session.
No, I think there are certain winning themes which are there for sure. So, for example, if you're building a solution focused on developers, India is a very good market in that particular sense. We have the largest workforce of developers in the world today. So you have a lot of captive client base that you are closer to for you to build out initial products, see the deployments, and then take it to global in terms of making more money, right? Similarly, if you're looking at global SMBs, small and medium businesses, India again has a lot of edge because you again have a very a great mix of digital maturity and paying propensity for these solutions, which helps you figure out what to do, what solution really work, right? So that's why you see a Zoho or a Freshworks or a ChargeBee take for example Zinnov, right, working really well from India. From a large enterprise perspective, the thesis still stands strong, right? We know we have a cost advantage. We know we have a good talent. We know we have a great ecosystem. There's a good cost arbitrage. But I think all three of them are winning themes for India. I think in the upcoming report, what we are trying to sort of go into is to say that is the India advantage still relevant, which we thought would be, is that still relevant, and consequently, will these outcomes continue or not? Our right now data says that the India advantage is still strong. It's not gone away despite the salary hikes during 21. Despite actually salary hikes through 2022 also for that matter.
Got it. I think we're going to go little in depth to certain industry level questions that we have got. This is again related to defense. What percentage of corporate and startup collaboration has been successful? What are the challenges in Indian ecosystem to make this a successful model? Any thoughts on defense related startups?
Yeah, I think generally the benchmark for any startup program across the world is a 20 to 30% conversion in terms of all of your experiments actually converting into deployments, right? A note for internal innovation, that metric is best case scenario is 10%, right? For startups, typically seen as 20 to 30%, 20% being a good number, 30% being a great number. And that continues across the industries. It's a very, very validated part, which is there. The better you are in terms of your processes, you can look to push this up to 60% from a conversion rate perspective, right? But I would always go for 20 to 30% with a certain throughput rate and not worry about 60% because that just works much better in the long term. In terms of aerospace and defense, I think right now what we are seeing is two segments of collaborations really happening. Defense industry by itself is very quiet industry across the world, especially in India. So a lot of collaborations are happening at a technology level. You typically get to know of this once the product is announced, and that too if you do a lot of search to figure out who really build the solutions out. But if you look at the average age of a lot of software embedded systems electronic companies, it's under 10 years right today. So a lot of activity happening there. They don't get covered in the typical startup ecosystem. On the aerospace side, it's still difficult in India, but I think a lot of activity which has happened is is in terms of changing the business model or the cost structure fundamentally, right? So, for example, in drones or in terms of aerial vehicles, you will see good ecosystem in US and Europe, but that always doesn't work in India from a cost perspective. Similarly, a lot of Chinese solutions work from a cost perspective, but they still require complexity of an American or a European company, right? So how do you make both of that work is what a lot of emphasis is on. Within aerospace, we expect, a lot of work happening in terms of space part or in terms of critical components within aerospace or in terms of what do you say, unmanned vehicles, both from civilian and from military usage. Civilian predominantly, again, from remote access, healthcare, disaster management, those kind of use cases are what's going to see a lot of uptick in terms of efficiency. And this includes public goods, let's put it that way. So it could be agriculture spraying, it could be surveying. That's where a lot of major uptick will happen overall, right? The payload capacity that companies are going after is typically 50 to 100 kg at most, 50 kg being a good threshold. But otherwise, it's pretty simple in terms of long range missions with lower payload, but very mission specific configurations. That's where a lot of emphasis is going currently.
Got it. I think that's the reason why we see an uptick in the startup collaboration, specifically in the defense and the aerospace industry.
It's a lot from experimentation perspective right now. What is available from a public domain perspective in terms of information? What we realize, down the line is it's also about solutioning, which is happening. But yeah, I mean, I won't say that say a BrahMos will have a startup solution right now. If it does, odds I will not get to know of it until much later.
Another industry-specific question on enterprise IT. We are interested in improving how we build technology products, for example, leveraging better DevOps solution. How is enterprise IT space evolving in India? Can this be an area to kickstart open innovation program?
I personally think so. And my reason is very simple, is that in a recessionary environment, there is always going to be it's always going to be difficult to get budgets. Yes, technology adoption is going to increase, but there will be a pressure to do more with less. In that construct, we spoke of use case prioritization, we spoke of startup collaboration. I think there's also a lot of merit in terms of looking at, for example, improving your cloud spends, right? There are startups, and we have these examples from GCOs also, where they have a community of practice which reduce the cloud spend by 10%, right? And there are startups who can do that by 20%, 30%. In say 7 out of 10 cases, right? Now that's a significant amount of money saved, right? That same money is what the CTO's office can now redeploy for another internal innovation project or for accelerating development of a product which is super critical from a mission perspective. So there is a need to create our own money, if nothing else. And while solving for that, productivity, efficiency, cloud spends, all of them come into play. And I think there is a lot of merit for the technology teams to to sort of proactively see how to change how engineering is done, right? How to rethink stuff.
Got it. Another interesting question, and in fact, I remember this was one of the questions. I mean, topic of discussion we came in our last meeting with our leaders. Large enterprise get a bit wary while adopting a startup solution in case the startup has not raised enough capital, or a risk of the startup going bust is always on the mind of enterprise leaders. How are enterprise mitigating this risk, and how are startup addressing this concern? What's your thoughts on that?
I think it's a fair concern. The best scenarios we have seen goes back to the concepts of use cases. Where you look at it on a case-to-case basis, because you know how critical that particular specific use case is for you, right? Number two, you also know what kind of complexity would be required to deploy a solution, into the system. So basically, what you're looking at is what is the cost of replacement, right? So how I or a lot of leaders end up doing today is to bring in this element of contextualizing to the use case, number one, and within that bring in the cost of failure or cost of replacement as a question to be answered, and then deciding, okay, should we even go with a startup on this or not, or should we maybe invest in this company so that it ends up running for a longer period because we just have a better return coming in. So you have a lot of options to solve for it, but fundamentally how I would say is that it's better to do that at a startup to startup, use case to use case level, than be very, very generic.
Got it. Another question on the success rate, but slightly modifying the question. Let's say a company who is still mature enough in the maturity curve and a company who is in the early stage of a setup. Uh, how can they rate the success rate of the startup collaboration with corporate in delivery to solution to problem statement in the last 5 years? Basically, a company who is pretty new in India, how should they think for startup collaboration and the metrics to be tracked versus a company who is into the maturity curve, high end of the maturity, how they should think of collaboration?
Yeah, I think regardless of where you are in maturity, in terms of in India, you should go and figure out how to work with startups. If you're newer in India, you should start sooner than later, because right now, also you've already created a case that this is not just a low-cost center, it's a high-value center in future. You need to start making that muscle sooner than later. Yes, you need a critical mass, and I would say that critical mass is somewhere between 50 to 100 people. If you have technical directors and above being in India, then 50 is a good number. If you don't have them, then maybe 100, 150 is a good number from a critical mass perspective, right? But I think for me, the criteria for any of these startup or open innovation program or academic programs is, do we have the right people giving the right amount of attention for us to do this? If that is there, age doesn't matter in terms of how long you've been in India. Number two, the metrics are very, very similar. Your first year metrics cannot be deployment or outcome metrics, right? A typical startup POC takes about 3 to 6 months. It takes about effectively 9 to 12 months minimum for it to convert from a use case identification to a deployment, right? So there is no way, you want to take the risk of putting a business outcome in the first year. Usually you go for leading indicators in the first year, start adding, business metrics in second year, and make that as the, core case in the third year. All right. So it's almost a 2 to 3 year journey before you start making sizable business impact, right? Which is there. So that's the other part, right? It doesn't change between new or an old firm. You just figure out that, okay, we can do this in 2 years or 3 years. That's the only difference. Anything more than 3 years, leaders won't accept. Anything less than 2 years, you are taking too much risk. So I would always go for 2 to 3 as a window. Leading indicators first year, lying indicators year 3.
Understood. Another question, I think, that we hear a lot, hey, I have a strategy office. Do I really need to have an innovation office per se? Or is that good enough for me to run an innovation program as such for my company?
I mean, I would always bat for a dedicated team. Now, you can put that within strategy, you can put that within innovation, because see, what you're really doing right now is you're not trying to find people who will innovate themselves. You're looking for people who will enable others to innovate, right? Currently, innovation is seen how HR was seen 50 years back, that it is line manager's duty to innovate. There's nothing wrong with it, but the reason HR department was created because there's certain elements of that job of people management which need to be solved at a company level, which requires some kind of specialization, certain kind of skill sets which are there, right? And if you take the same analogy, then what the innovation office is really doing is creating certain set of capabilities and skills which can enable a technical director or senior director to get the job done a lot more faster. They can focus on what they are good at or great at, right? And these folks can help them with other stuff. So in that sense, strategy and innovation office should really, really be integrated in that particular part, but there needs to be a team focusing on how to make it work, within the company.
Got it. Atit, your last thoughts. I'll break this question into two parts. A is, if a company is right now running a startup collaboration program or an innovation program, what they should think or how they should look 2023 to 2025, what should be the strategy? And number B is, if a company is looking to start their innovation program as such, what should be their focus area and what should be the initial steps to look upon from the ecosystem point of view per se?
Got it. Number one, go global. I think there's no need for India, GCOE or Indian MNC to limit itself, which is there. Number two, pick up use cases that have a good probability of an outcome in 9 to 12 months. Preferably there should at least be 50% of the use case on the cost saving side. It is a pool of capital C2 can redeploy for something else, right? So right up into the leadership, there's a lot of value for that. 50%, you look at other parts, out of which I would say 20%, can be moonshots, but I would say 30% have a good odds of success in 12 to 18 to 24 months kind of a bit, right? Which is the top line focused. So I'll go for a different composition this year, next year, in terms of what kind of use case I'm taking, because somewhere the program have to fund itself, right? Very soon, right? And you want to start creating capital to that. The third part, which should be somewhat important, and in terms of the evolution, is to actually have a conversation regularly with all the leaders of how the program itself will evolve, not to mix too many things together. The biggest challenge which comes in a lot of open innovation programs is that everybody in the room has different experience. There's not a common language, and consequently, it's very anecdotal in terms of the conversation, right? So there's need to create a common language and common vision in terms of how this capability will evolve. Do that very, very proactively. Yeah, I think the last piece would be is fundamentally to see this capability, right? This is a capability. It's not an event. It's not employee engagement activity. It is not a sideshow. So it will be important to get the leadership time, but pitch this as a capability. And odds are you'll get enough room to figure things out.
Understood, Atit. Thank you so much, Atit, for taking our time and answering most of the questions that audience have asked. I see a few of them has sent a personal note saying that you want to connect with Zinnov to understand more about innovation. Happy to do so. Please do expect a email from our side, a thank you email, and we will definitely share the full report, but allow some time till around 17th because the release is due. And in case if you really want to understand more about innovation and or if you have any queries, we'd be happy to take those offline. Thank you very much to all the attendees who have attended. I know this year is somewhere we will see a lot of uptick happening in the startup ecosystem, startup collaboration with corporates and GCOEs, and we are all positive about it. Thank you so much. Thanks, Atit. We hope to see all the attendees soon in our next event.
Thanks, Prashant. Thanks, Nali. Thank you, everyone. Have a good day. Bye-bye.